On February 26, 2014, a group of congressmen sent a letter to then Attorney General Eric Holder. In the letter, they requested that the Department of Justice continue to pursue a, quote, vigorous review of potential fraud related to banks and third-party processors. Banks and third-party payment processors play a central role in the operation of the payment system, and all Americans depend on the vigilance of banks and payment processors to ensure they do not become unwitting victims of fraudulent schemes. There was plenty more, but this seems to be the real thrust of the issue. Saying the DOJ and the FDIC should continue to vigorously review fraud sounds all well and good, but this took a near immediate turn for the worse. In the overview, we talked about the, quote, high-risk activities. The FDIC had made a complete list of these activities as obtained through court documentation of Advance America Cash Advance Centers Incorporated et al. Versus Federal Deposit of Insurance Corporation, the FDIC. Those activities were ammunition sales, cable box descramblers, coin dealers, credit card schemes, credit repair services, dating services, debt consolidation scams, drug paraphernalia, escort services, firearm sales, fireworks sales, get-rich products, government grants, home-based charities, lifetime guarantees, lifetime memberships, lottery sales, mailing lists / personal info, money transfer networks, online gambling, payday loans, pharmaceutical sales, Ponzi schemes, pornography, pyramid-type sales, racist materials, surveillance equipment, telemarketing, tobacco sales, and finally travel clubs. This brings us to what happened in 2014. A number of porn stars came forward to discuss how they had been denied loans, refinances, opening a bank account, or even maintaining an already opened bank account. Based on the variety of articles on the subject, there were a wide variety of banks involved, big to small, but some headliners include JP Morgan Chase and Bank of America. The through line for these problems was being unexpected. From attempting to refinance a studio to simply trying to access their bank account, the porn stars were often told, without a solid cause or reason why, they could not complete the basic transaction. They weren't alone. The NRA even published a statement regarding firearms manufacturers being required to close their accounts at, you guessed it, Bank of America. The bank denied having a policy that would stop them from doing business with firearms manufacturers. That statement may very well have been true, as it appears entirely possible that the DOJ or FDIC had this policy and Bank of America was just complying as directed. This line of deniability, where no one is responsible, is exactly what permitted this operation to continue. How did this actually work, though? Former director of the Consumer Protection Board of the Department of Justice issued a memo outlining exactly that. We principally are pursuing civil rather than criminal investigations. Criminal investigations can take considerably longer to complete and generally require a more intensive investigation. Only if an investigation presents particularly egregious criminal conduct are we opening it as a criminal investigation. We are targeting banks more than payment processors, and payment processors more than merchants. Any one case, whether against a bank, a processor, or a merchant, takes substantial time and attention from our team. Bank cases will deter other banks, thereby stopping the processing of transactions for fraudulent merchants and the processors with which they work. This may mean filing civil complaints or criminal cases against banks based on transactions with fraudulent merchants and or processors, but not filing against the underlying fraudulent merchants or processors. This practice is not optimal and may present litigation risks, but it may be necessary to prevent the initiative from grinding to a halt due to resources used pursuing the merchants and processors. What did that look like? In one example of blatant intimidation, a bank terminated its relationship with a legal business after threats from the FDIC. The bank eventually surrendered to the pressure, and when the bank notified the FDIC of the decision, they admitted that a risk assessment showed the business, quote, posed no significant risk to the financial institution, including financial, reputation, and legal risk, end quote. Yet they still terminated the banking relationship. For years, Office of the Comptroller of the Currency officials have continually denied any wrongdoing. Yet in the newly unsealed documents, we see proof of a conscious decision to work in conjunction with the FDIC against payday lenders. A lack of due process, or even the illusion of due process, seems obvious, and yet these cases were pursued and won by the DOJ. They were even reviewed by Congress to see if they were legal. In U.S. v. Four Oaks FinCorp, the bank settled with the government, agreeing to pay a total of $1.2 million to the U.S. government because they had done business with third-party payment processors that were alleged to include a large number of internet payday lenders that engaged in fraud against borrowers. You heard that correctly. The government alleged that the third-party payment processor was doing business with other people who were committing fraud, and the bank, all the way at the end of that chain, was charged. This charge required a premise that banks may have their reputation damaged if they are involved with fraudulent activities, even if the bank is in no way financially harmed themselves. This was the, quote, know your customer, end quote, doctrine espoused in the late 1990s and currently offshored to international banks that don't seem forthcoming about what that policy means now. Congress determined this wasn't illegal because the court was duty-bound to ensure that settlements were legal. It didn't matter how dubious the entire situation was. It didn't matter that the operation was not prosecuting the actual fraudsters. If the courts had found it to be legal, it was. The other two cases in which Congress examined are no better. The end result of their investigation was that the either 50 or 60 subpoenas that had been issued were just in the course of duties for the Department of Justice, and the 3 actual prosecutions did not violate professional conduct. A strange answer to the question of the operation being legal. Despite all of that, in 2015, the FDIC admitted to using Operation Choke Point to target gun stores and their banking relationships. At the same time, the FDIC issued this statement telling banks that they shouldn't decline whole groups of businesses their service, but rather they should specifically target individuals using risk assessments of those specific individuals on a case-by-case basis. Again, you may note a lack of due process or anything resembling it. These institutions were to make a, quote, risk assessment, end quote, which could include, by court precedent, damage to their reputation even if there was no monetary damage. Up next, we tried to fix this and why that didn't matter.